All right. Good morning and a warm welcome, everybody, to Innorate's webinar focused on relations with early stage investors and banks, together with our expert, David Gill. My name is Edward, and I work as a project manager for the European Business and Innovation Center Network, based in Brussels. We're one of the implementing partners of the Innorate project, and today I will be your moderator. Now, with this being said, I would just like to quickly introduce you the webinar interaction tool for those of you who are not familiar with the GoToWebinar platform. So we want to try and make the session as interactive as possible, and we look forward to a lively discussions. So please do feel free to send me your questions, which you can do via the question box directly in the panel on your screen. Also, the registrants received an email from my colleague Eveline asking you to send us some of your questions prior to the webinar so that we could tailor the Q&A session to your specific needs. So we've received some questions and we'll make sure to ask them during the Q&A session. Yeah, with this being said, I'm extremely happy to be able to introduce today's speaker, Mr. David Gill. David is the managing director at St. John's Innovation Center. He is also acts as the non-executive director of the ET Capital, which is a firm that manages several funds specialized in the science-based sector and businesses around the London area, obviously Oxford and also Cambridge as well. He is a Sloan Fellow at Stanford Graduate School of Business. And he also is an official visitor at the Institute for Manufacturing at the University of Cambridge. David has extensive experience in corporate finance and has worked for both US and UK based banks. And he was also instrumental in setting up the technology and innovation unit at the HSBC Bank in London. I'm sure everyone present will join me in thanking in welcoming you, David, and thanking you for your time, and we very much look forward to your presentation. So just before David delves into his agenda, the agenda of his presentation, let me take a couple minutes to present to you the Innorate project. So for those of you who are not aware of the Innorate project, Innorate is a EU finance initiative under the Horizon 2020 program. The main objective of the project is to really drive the move towards the development of a EU financial system in which tech-driven SMEs with growth potential have easier access to the financing solutions required to scale and grow, obviously. And to do that, Innorate has basically developed a service platform that links, on the one hand, innovative SMEs with investors on the other hand, and this is done through an objective and forward-looking sort of technology and rating methodology. Innovate is being implemented by a total of 9 partners, which you may see on the slide. And as a consortium, the way we like to describe Innovate is that Innovate brings innovation to finance and finance to innovation. So that is an introduction to Innovate in a nutshell. Obviously, I'm conscious of timing, and I'd like to give as much time as possible for David's presentation. But before we hand over control to David, I'd like to present to you some of the barriers that are currently being faced by European SMEs when trying to access finance in the European context, because this will provide you with a bit of background as to why the Innovate project was created. All right, moving on. And yeah, so when looking at the barriers to financing innovative SMEs in Europe, one of the main elements to consider is the capacity of investors to assess and rate disruptive and market creating innovation. The question is, why is that? So innovations, and this is especially true for innovations in high growth sectors, are characterized by high technological, manufacturing and market complexity. This leads to the assessment of the innovations requiring both market expertise, but also an in-depth technology understanding. And I think this sometimes results in investors maybe not necessarily undertaking these assessments because they might lack the technological expertise to do so, but also a question of time. It does take a significant amount of time to be able to assess, the potential of a specific innovation as well. Moving on, and we're looking now at data. So the second element to consider is data. As you know, data is king nowadays, and specifically data to facilitate the assessment of a market potential and obviously the risk involved with a specific innovation. As you all know, nowadays data is scattered across the internet and comes in different formats, which makes it extremely hard to analyze sometimes. Data is also sometimes hard to find, costly to access, and sometimes even simply missing. And also data has access restrictions and prices imposed on their use. And this is exactly where the Innovate project and its service platform comes into play and tries to tackle these barriers that are being faced by European SMEs and investors. So our concept is simple. We're developing a service platform that is aimed at supporting investors and lenders for screening, prioritizing, and especially trying to finance innovative SMEs with great growth potential. So if you're a highly innovative SMEs, Innovate can help you with the following. We can help you better understand the potentials and risks involved with your innovative solutions. We can make your prospect clear to potential investors who have already registered on the platform. We can rate your innovations quite easily. So this is done via the deep assessment function on the Innovate platform, in which we match you with an expert specialized in the field, and that expert will undergo a deep assessment of your innovation. We can obviously mitigate some of the investors' perceived financial risks, and we can support you in getting easier and faster access to financing solutions in order for your business to grow and scale. All right, so we've looked at the financing barriers faced by innovative SMEs in the European context. We've quickly introduced, in a nutshell, the solution that Innovate as a project and its service platform brings to the table. I think now it's enough about Innovate. I think we should provide the platform for David's presentation. So David, the floor is yours. But before that, let me change and design you as presenter.
Well, Edouard, thank you very much for that introduction, and also for the insight into a really interesting product and service that you're working on at the moment. So thank you very much for that. And ladies and gentlemen, I hope you can all see my screen. I think
yes,
that is all showing clearly here. What I'd like to do over the next, let's say, 35 minutes is run you through an understanding of the funding landscape for early stage, high potential businesses, particularly those that are based on innovation, not necessarily technology, but generally speaking, innovation. And understanding the mindset, the drivers or providers of finance, which at the really early stage is likely to be equity rather than banks. But I would also argue that preparing yourself to be bankable is an important skill for the later stage of your journey. So that is the menu for the next half hour. If I move on for one general overview, which I think is quite important, it's having a mind map of where you're likely to fit, in particular, so that you know what type of funding opportunity you are, and therefore what type of investor you should be approaching. And along the x-axis, along the horizontal axis, I've put in generic terms the descriptors of the various types of funding, particularly equity funding at early stages. What I would say from a lot of recent experience is that it's quite often difficult to get even practitioners and experts in the field to agree exactly at what point does seed stop, at what point does startup stop, when do you move on to early growth. It's not necessarily about the number, it's probably more to do with the characteristics of the company. And to get to the stage of early growth, that should be where you've already done the proof of concept, the proof of market, and what you're looking to do is to scale pretty fast, so that perhaps when you're in the early growth round, you've only got one or two more funding rounds to come. Just to underline that point, I was doing a training session with the Royal Academy of Engineering this time last week, when the various companies on the call discussed their experience of approaching venture investors for what they described as Series A. And the range on the call went from below 2 million euro to above 5 million euro. So I think it is a case more of the characteristics rather than the sums involved. Ultimately, and this might seem slightly old-fashioned of me, particularly in a world which is based so much on the idea of exponential growth through external funding, realistically, most investors will want to know at what point does your business start to be funded from the people who are buying what it is you've got on offer. And from your point of view, that has all sorts of other advantages as well, not least that if you're substituting money from clients, you're not parting with any more equity. Another final piece of introduction I would cover is to say that I tend to work with two types of company, particularly those which are coming out of universities. You often have companies which are more like a consulting firm. In other words, you've got the people who've developed a new type of technology, and in effect what they're doing is acting as consultants to established firms, enabling that technology to be deployed within the established firm. If you do that, you probably won't need much external funding, but on the other hand, you can't actually scale the business that fast, because the real assets, apart from being able to license a patent, let's say, the real assets are your time, your know-how, and that of your team, and there's a limit to how far you can scale that. So yes, of course, if you are a genuine high potential firm based on the deployment of technology on an industrial scale, the likelihood is you will need considerable amounts of external funding, but you won't get it all in one go. You would have to plan to get that in various steps, in various stages, once particular milestones have been met. And that takes me on to the other introductory subject, which is how should you go about approaching investors and indeed banks? And I would say you've got to have a plan. You've also got to realize, what do you look like? How do you come across to the people on the other side of the table? To give one starting point, which I think a lot of early stage companies tend to overlook, it is that you will be at your strongest in terms of your bargaining power the more you've got fuel in the tank, the more you've got cash in reserve that enables you to run the business before you go to the investors. And once you're in the last few months before you run out of cash, your bargaining power is pretty low indeed. Later on this afternoon, regrettably, I will be on a board meeting by telephone with one of the companies where I'm an investor. which is going to have to make a make or break decision about whether to accept some emergency funding, because it's been trying for 3 months now to get in a big venture investor. It hasn't succeeded. And the decision it's going to have to make this afternoon is based on the idea that it's pretty much out of cash and it doesn't want to trade whilst it's insolvent. That's how serious it can be. Another point about your timing, about your strategy, about how you come across to potential investors is this. It won't always be possible, but it is a great advantage if you can go to external sources of funding immediately after you've achieved some significant inflection point. An inflection point could be you finally had your patent granted. It might have been applied for 2 years ago. You've had to put in more and more information, but it's now been granted. Once you start getting customer sales, even if they're soft sales, they're beta sales, that's pretty impressive. That really matters. So it won't always be possible, but if you can go to investors and say, look, we've just hit this milestone that we discussed with you informally a couple of months ago, that is likely to help your case enormously. Coming back to the issue of your strength as a negotiator, a question that a lot of investors will ask you is, what is your burn rate? And a burn rate in technical speak is your negative cash flow. Once you run out of cash, that's when you have to go back to shareholders or find a new business. Often burn rate is expressed in an amount per month. So for the sake of example, if you are already making some early stage sales, bringing in 100,000 euros a month, but you're spending 150,000 euros a month on salaries, on research and development, on marketing, your burn rate per month is 50,000 euros. It's a number you really do need to know, partly because investors will ask for it, partly because it enables you to plan. It enables you to know how much further you've got in your runway. And coming back to the issue of how do you negotiate with your investors, it is all about the strategy. I don't think you can go in and simply say, we need this amount of money and we're prepared to sell this amount of equity in order to get there. I think you've got to work out what the overall parameters are. Would you be prepared to part with more equity if the terms come with the promise of more funding later, for instance? Would you part with more equity if working with a particular investor meant that you got some really valuable introductions to new clients? So work out what your strategy is. Your starting point will be what you really want, but you also have to recognize that investors will have different drivers. I'll be talking about those in a moment. So taking those into account, it really helps if when you go into that negotiation, you know there's a point below which you won't go. And at that point, you have to politely withdraw. If you haven't worked it out before, it might come as a surprise to you during the negotiations. And you never want to be taken by surprise. And you certainly never want to look as if you've been taken by surprise. I won't spend a lot of time this morning talking about either what goes in the business plan or goes in the pitch deck, but I do want to touch on the fact that, especially when you're talking to equity providers, the people you really want to have as investors will receive hundreds of plans every month. You must do something that makes you stand out. You must do something that makes you look exceptional. And if nothing else, it's worth working on that 2-page summary so that you've internalized it, you've memorized it again and again. It's something that you can bore your family and friends with. You can explain what the business is. You can explain why it's such a big opportunity, why it is you are the team to solve the big problem that you've identified. And another way of thinking about how you present yourselves is always thinking in terms of the elevator pitch. It's worth honing that, working not with the people in your own team, but probably people outside, mentors or other advisors that you've got close to in recent months, who will give you, shall we say, frank feedback as opposed to encouraging feedback. Because when you go in front of the investors, they will be giving you the frank feedback, and you need to be able to anticipate that. Just as an example, There's a company I'm working with at the moment that is looking to raise 2 million, and they were invited to meet an investor who wasn't on their hit list last week. I said to them, go for it. This is the first time you've actually had to pitch in anger. Although you've been rehearsing with me and with your non-executive directors, there's nothing like having to present in front of a real investor. Because this isn't your ideal investor, you don't really mind if it doesn't go that well. So treat it as a practice round. But always, always be thinking in terms of your elevator pitch. Moving on a little bit more to understanding what your strategy really means, I don't think you can develop one unless you understand what's driving the investors, particularly the equity investors, but also understanding why banks will probably only be interested at a later stage. I'll be talking in a moment about how venture funds in particular are organized. They have time pressures, they have pressures on them to get financial results in the same way that you do. So you need to understand where the fund is in terms of its life, for instance. It helps if you can dig into how much of the technology are the particular people you will be seeing or approaching, how much will they understand. At the moment, at St John's Innovation Centre, we're running a pitching program for 15 companies in the east of England. And next week, when we do the dress rehearsal for them, we are making sure that each company has had a snapshot of the investors to whom they will be presenting, so that they know just how much detail to go into on the technology. They understand what other companies are in the portfolio of the fund that they're investing to, and so forth. So you do need to do that background. You can't assume that all investors are the same. And this brings me on to the problem that most entrepreneurs face. It's a perennial conundrum. I suspect that if you come from a tech background in particular, you will believe that it's the technology, the idea, which is supreme. What really matters to the investors is what you do with it, how do you conquer a market, and ultimately, how does the company get an exit? I'm acutely conscious of the fact that all entrepreneurs are desperately short of time, and it isn't helped by the fact that they're probably short of cash as well. It's not as if you can go and buy resource or outsource some of the work to a consultancy. You just don't have that. On the other hand, what I think you've always got to build on is the fact that, particularly at early stages, where there's little evidence of market traction for your company and your product, what investors will be looking at is you, your personality, the personality of the team, the coherence of the team as a whole really, really does matter. And coming back to what I was saying earlier about understanding the investors themselves, it will help if you've got some understanding of the particular people to whom you're pitching. That will build a great deal of confidence when you're in front of them. Don't bury your head in the sand, don't become an ostrich. It may be that when you start doing your research, you think, well, this is going to be a lot more difficult than I thought, but it's best to face up to those problems whilst you still can, whilst you're still in the planning phase. Let me move on to some of the drivers for equity investors. And it would surprise me if you haven't heard some of these numbers before, if not necessarily in this format. You might think, if you've heard angel investors speak, for instance, that the kind of returns they're looking for seem very high indeed. Often angels say that we need to get 10 times our money back on our successful investments. And that might seem greedy, but in reality, of course, it isn't. Because what both angels and venture funds find is that on average, a portfolio will look something like this. If you make 10 investments, you'll find that 3 of those will fail pretty quickly. You end up with maybe 4 or 5 companies that don't fail, but they're going nowhere in particular. They're what's sometimes called the living dead or the walking wounded. In many ways, from the point of view of an investor, that's as bad as a failure, because at least with a failure, you can write it off. You don't have any more time or hassle. Sometimes you can claim the failure back against your tax expenses. But what drives the investor is how many stars will there be in a portfolio. Almost on a random walk basis, you would expect one company in 10, if you've got reasonable quality deal flow, to be quite successful. In a good vintage year, maybe 2 companies in 10 will be very successful, but it's only going to be the star funds that have 3 really successful companies. And if you think of those numbers, if 3 of those companies produced 5 times the initial money, then you've produced 15 units back, so to speak, out of 10. So you've made a profit, but it isn't a huge profit given the level of risk that you were running, and indeed, given the level of risk that the investors in you as a fund manager were running. Because in many ways, venture fund managers are like you as entrepreneurs. They're regularly out there raising money. They're raising money for their next fund. They're raising money from people like family offices, sovereign wealth funds, maybe from high net worth individuals. But they also have to go back to their investors and account for themselves. And if at the end of the life of their fund they haven't done well, they won't be able to raise the next fund. And life for a fund manager will, in theory at least, look something like this. Let us say I managed to raise a €100 million fund, and over the standard life of a fund, which is meant to be 10 years, I'll be saying a bit more about that later because theory and practice are not quite the same. But over the 10-year life of the fund, if I've managed to multiply the return 10 times, when I come to distribute the profits to my initial investors, I will be entitled to what's called a carried interest, which is in effect a bonus payment, of 20% of the uplift in value. And 20% of the uplift in value on a fund like this is considerable. It would make me and my partners as fund managers very rich people, so we would be happy for that reason. It would make the investors in our fund even richer, and they would like us enough that they would want to invest in our next fund and probably our fund after that. Whereas if we'd only managed to return a small profit, they would be polite, but they would never return our calls again. They wouldn't invest in our second or our third fund. So those are the pressures that the equity fund managers face on a regular basis. Let me turn now to what your relationship with a bank is likely to be. And again, I come back to the idea that because at the stage before you're generating regular sales and therefore generating regular cash inflow into the business, you're probably not a suitable candidate as a company to receive a bank loan. Banks don't sell you money, so to speak. They rent it. They want to be repaid, and what they charge you is interest. So even a relatively long-term loan might only be 5 years, and 5 years in the life of a startup company is probably not long enough for you to be sure that you could repay the loan. The obvious distinction between the banks and the equity investors is the equity investors become co-owners with you. They're in it for the long term. They acquire part of your business with you, and the exit will be for them probably at the same time as it is for you. To give you one more example of why I'd say that until you're generating a regular cash flow, going to banks is not a good idea, either for you or for the bank. I've put together this somewhat fictitious example of a lending manager for a big bank who lends €1 million to each of the 100 customers in her portfolio. So her value at risk is 100 million euros. Let's say that she was able to charge an upfront arrangement fee of 2%, and the annual margin is 5%. Then the total income to the bank on that portfolio in the first year would be 7 million euros. Most banks have a cost-income ratio of about 50%. In other words, to be able to have a branch network, to pay for the staff, pay for the training, pay for the IT, and so forth, they have to spend 50 cents in every euro that they earn just keeping the company going, which means that the net income to the bank on that huge portfolio is only 3.5 million euros. So if 4 of those companies actually went out of business quite quickly, the bank would make no profit at all, no return on the entire portfolio. And given the failure rate of early stage businesses, you can see why banks don't really like lending to early stage innovative firms. Another way of looking at it is Duncan Matthews, who used to run the innovation and technology team for NatWest Bank, used to say it was partly about psychology, that banks like things which are steady, stable, forecastable, where you've got a lot of data. If you're an early stage innovative tech firm, it's likely you don't have much of that. You've got a great deal of longer term potential. And as of today, you don't have the data, you don't have the stability. It's very difficult for you to go to a bank and say, with a high degree of confidence, this is what we're going to do next year and the year after and the year after that. However, it is worth you trying to build a relationship with the bank for reasons other than borrowing. The obvious one, of course, is that when you receive your first investment from an angel syndicate, let's say, of only €1 million, you need somewhere to put that money. You need money transmission. It could be to pay your staff. It could be to pay your suppliers. It could be to help you with exports. And the point that I've experienced in my own professional career also is that if, as a tech firm, you establish a relationship with a bank early on, then when you are at the point where you've got regular cash flow, the bank has got your track record. It will feel much, much more comfortable lending to you. So when you get to the stage later on my funding landscape, where you've perhaps gone beyond Series A of venture investment, you could supplement the funding you receive from equity with funding from debt as well. So don't leave out the banks, but don't rely on them for risk funding in the early stage of the development of your business. This leads me on to what you should be looking for, particularly in the investors who you want to approach. And not all money is the same here. There's an element of the added value that comes with different investors. A surprising fact, and I owe this chart to one of my colleagues who last year was researching what's called patient capital, very long-term equity investment. She found that in reality, if you looked back over the past 25 years of venture funds in the US, and she used US data because there was a much longer track record of more funds over there than over here in Europe. She found that in reality, although fund managers talk about having a 10-year life, the median life of most venture funds is more like 14 years. And part of that is because the underlying portfolio companies take so much longer to mature than was originally expected, that the fund managers have to go back to their investors, to the sovereign wealth offices and the investment banks, and say, could we have an extension and another extension? So that's a little bit of a surprise. Another one is this. My colleague was looking at how long did it take from founding date to exit for some of the biggest recent European exits to happen. And a relatively short run was 6 years. You can see from there that companies which have been very large exits and very successful early stage investments for their founders have taken 15, 16, sometimes 18 years to reach realization. So that's by way of background. Yes, of course, the funds will be getting twitchy if they think that your initial business plan is going to take more than 10 years to get an exit. But in reality, there could be other drivers happening behind the scenes. What I say you should be looking at when you do your research into the venture funds is some of it is obvious. Make sure that they do invest in your sector. And the number of companies that get that wrong is extraordinary. Do they invest in your stage? And that can be tricky because so many funds don't publish realistic data on their own websites. So it could be that, in fact, you have to do your research through one of the proprietary databases. The one that I tend to use a lot is Bowhurst, but there are several others out there. If you can research published data to work out exactly where did the funds get involved, that is useful. The size of fund really matters, not least because if the fund is getting close to its expiry, it's almost fully invested, it's unlikely they will want to invest in you because most fund managers will be holding back some of their capacity for a second and a third round. Other things to discuss probably with your mentors and your professional advisors are those funds that you've shortlisted. Will they be able to bring in other investors if you need more money? Does their existing portfolio contain companies which you might consider to be competitors, or are they companies which are complementary? And in fact, that could be quite a good thing. For instance, at the moment, or possibly by coincidence, I'm not sure, with the 15 companies that we're working with on this particular accelerator program, many seem to be in artificial intelligence and robotics, and they find it quite useful to be able to cooperate together. They're uplifted by the cooperation rather than challenged by the competition. We've talked a little bit about the real value add. I think that's where talking to companies that fund has already invested in is quite helpful. Do the investors simply turn up for board meetings having read your report the day before, or do they bring with great deal of industry and commercial knowledge that they can share with you? And finally, sometimes there are a few funds out there who are so well known in the industry that simply having them as an investor is almost like having a stamp of approval for your company. I wouldn't say that's something worth chasing, but it is worth thinking about. Let me move on a little bit to the sort of information that funds want, both before and after. I guess those of you who've already been approaching investors know that on the whole, the key indicator is the cash flow rather than the balance sheet or the profit and loss account. And as founders of businesses who often are close to running out of cash, monitoring your cash is one of the most important things you can do. I'm sometimes asked, is there a particular template to follow? The answer tends to be that with management accounts, it's a case of what is the most practical, what most suits you. However, once investors have put their money in your business, almost invariably, they will have a particular format that they want you to follow. Either way, you should expect on a monthly basis at the least to produce something like this for your board and your investors. This was taken from a company I'm working with recently who had to produce a cash flow this time last year when things were getting very tight because of the pandemic. So the numbers could be reviewed by their non-exec directors and their investors on a regular basis. And I think it'd be fair to say that most experienced, most professional equity investors are used to the fact that your initial projections will look something like this. It's sometimes called the hockey stick, sometimes called the ski jump. They know that for the first 2, 3, maybe 4 years, you will be negative in terms of cash, and the hole keeps getting deeper. I've actually taken this one directly from the company I mentioned earlier that's looking to raise 2 million. It is in the artificial intelligence robotics space, and these are the predictions that it is presenting to venture capital investors this week and next. So this is something investors are used to. I would add, and regrettably in recent months this has happened a fair bit, that once your trading starts getting difficult and you're finding that you keep missing targets, you're finding that cash is getting very tight, it's quite possible your investors will want you to prepare a cash flow projection every week to be reviewed with them and the board. The format that I've got here is one which enables you to compare your actual performance with what your projected performance this time last week was, and then each week you would be adjusting your projections for the next 2, 3, 4 months until you think you're out of the difficult trading period. What is absolutely key is making sure that you never get into the position where you've got a reasonable likelihood that you will run out of cash and you will be trading whilst you're insolvent. That is something that would be wrong in law in most countries, and it's something your investors really, really dislike for other reasons as well. If you've got good financial projections, that's something you can work with. Just coming back to the sort of information that the investors will be looking for at the outset, their light touch due diligence before they get into things such as looking at your legal contracts and your ownership of intellectual property will be about the key things in your business plan. In my experience, most investors at the really early stage are backing you as people. So they want to make sure that you've got a rounded team that can work together. And if there are gaps in the team, you can identify upfront how you'll be able to fill those gaps. Simply having a patent isn't good enough. What they want to know is how can you exploit your intellectual property? What does it mean to be a first mover, rather than simply have the right to keep other people out of your territory? It always helps if you can show that you've got some early users, you've got some people who in principle at least are prepared to pay for what you're delivering. And you will need to show that as you scale the business, you've identified a way of turning sales into long-term sustainability in terms of profit. So you can't simply go to investors and say, we need the money, therefore please invest in us. You've got to show you're at that point where you've worked out what the problem is, how you're going to solve it, and why it is that you are the people to do it. Finally, there's a question that comes up a lot with early stage investment, and it's this. Most investors at the late seed or early Series A round know that you as a growth company will almost invariably want more money later. So you've got to be able to say what happens, where would you source it, what would the dilution effect on your first round investors be? And that is quite a challenge, but be prepared for that question. This leads me on to the communication with investors, both preparing for pitching itself and for the longer term relationship. I don't want to spend too much time on pitch because that's not the main subject for today. But I think if you've always got that at the back of your mind, you've got what are the half dozen key things that you always need to know, the questions that you can answer. It's never time that's been lost. It's reconnaissance that will pay you back a lot in the future. Another aspect of this is being prepared. And I come back to the example of the company I was talking about in artificial intelligence that's looking to raise 2 million at the moment. When they said, we've had an investor who isn't at the top of our list approach us, I said, go for it, present, because this will enable you to get used to pitching live in anger when the adrenaline's flowing. It will enable you to rehearse to get your language right. And I regret to say that again and again, when we hear the trial run for early stage companies, often presentations are written from very much from an insider's point of view. They don't explain what the fundamental problem is. They use a lot of jargon. They use a lot of acronyms. They assume that the people in the audience know who the people who are presenting are that they're talking about. So that's got to be something you iron out at the early stages. All of that you might say is just hygiene factors. But I would also say that if you can get people to grasp your idea and gasp and go, oh wow, that's great, then you're halfway there, and all the rest of it is just a detail. So work on how do you open to create impact, work on how do you close, and knowing how to close is partly knowing what you're going to ask for. Are you asking for a second meeting? Are you asking for investment? Are you asking for feedback? All those good things, but know what it is before you go into the meeting. Now, bringing this towards a close, I would say that once you've received the investment, it's true also of banks in many ways. What people who provided you with funding want is no surprises. They want you to focus on delivery. With equity investors, they will probably want at least one board seat. They want to know that you can control your cash, that you know how to use your financial dashboard. And in particular, they want you to get to the point of sustainability, which in this context means you will be funded through sales rather than through another round and another round of investment. The converse of that is that perhaps you weren't as either perceptive or as honest as you should have been when you were pitching to investors. You didn't disclose issues. You're not good at managing cash. I think the key thing is if things do start to go wrong, go and talk to your investors in the early stage, never surprise them. That is the thing that they find the most difficult to deal with. Don't treat them as the enemy. They now also own a piece of your business. You are all on the same side. So to conclude, I would say, going back to what we talked about at the beginning, that in the really early stages, it's unlikely banks will be appropriate for you. You might want to use grants to supplement your equity. Never wait until you're running out of cash before you go to raise investment. Don't be surprised if investors make an offer to you that's based on hitting certain milestones, so you don't get all the cash up front. You get some of it, and then you get more of it if you actually achieve the things you said you were going to do. Don't be surprised if you underestimate how much you think you need, and always use your mentors and advisors for honest, hard feedback, because that's what you'll get when you actually go in to talk to investors. And with that, and this little wisecrack from Guy Kawasaki, who used to be at Apple, I'm going to hand back to Edouard. Thank you very much indeed.
All right, many thanks, David, for this very enlightening presentation. I am switching my slides right now. All right. Yeah, so as I just mentioned, thanks a lot, David, for this very enlightening presentation. I think all SMEs who have joined us today really managed to get some very concrete tips and tricks. So really many thanks for this. I'm obviously conscious of timing. I'd like to give enough time for our Q&A session. And as I mentioned at the beginning of the webinar, we've received some questions prior to the webinar, so I'll start with these. And I saw some people sending us some questions via the question box, so I'll take those as well. Let's take the first question. For early stage investment, what evidence would an investor wish to see to convince them on investing, especially when market traction and sales will be low at this point of the business?
I think if you haven't got traction in the form of sales, then if you can have dialogue with potential customers and reduce that to the form of a specific wish list that they produced and show how you would be able to fulfill that wish list, so that you could then go back to the customers and say, here you go, this is what we can do for you, that would help. I would also say that the classic one of having free beta users, it's obviously not as good as people who pay you, but it does help enormously in showing that people will use the product and those users will give you practical feedback, so that if people have said, yep, I'm really enthusiastic, could you change this, could you change that, that will appeal to investors a great deal.
Thanks a lot, David. Moving on to the next question. And to what extent should I negotiate with investors? I don't want to risk losing their investment by negotiating too hard.
Wow. I think this comes back to having your strategy and knowing what your walkaway point is. So it could well be that you came to an initial view on what your company was worth. You would know how much money you need to get to the next milestone, and therefore you worked out what percentage of the company you're prepared to sell today. Don't be surprised if investors take a more conservative view, but do a certain amount of gaming amongst yourselves to how low or how high would you go. And my rules of thumb at really, really early stage are that generally speaking, investors won't go below 10% because that gives them no material stake in the business. But at an early round, you would never expect an investor to get a majority stake in the business. So most early stage investments end up somewhere between about 15 and 30%. That's just a rule of thumb.
All right, thanks. Is there a right time of the year to seek building relations with investors or seek investment?
I think with most funds, probably not. There is with private investors, because in many countries there are tax effective schemes that favor angels getting involved with companies. And if you're coming up towards the end of a tax year, it could well be that the private investors will be saying, I've still got 200,000 euros left of my allowance of €500,000. I'm looking for good investments now. So particularly I tend to find that a lot of deals in the UK close in March because our tax year ends at the end of March.
Okay. Actually, a question that we received that's especially relevant in the current context that we currently live in. How can I make myself more attractive to investors in times of COVID?
This is a really good one. I think something that we've seen a lot is making sure that early on in your pitch, you have explained to investors, at the very least, why you are still relevant in the time of COVID, and preferably why it is that during a pandemic, whatever it is you're offering could be more valuable. And last year, for obvious reasons, we had a fair bit of success with medical technology companies. And more recently, we're seeing companies that are providing alternative means of meeting, such as the one we've got now, companies that can do advice online through chatbots and the like. They're generating a great deal of interest. So don't do the ostrich, don't bury your head in the sand when it comes to dealing with COVID. Be on the front foot and say, this is why actually, despite everything, COVID is good for this opportunity.
Right, very clear. Should I accept an investment which I think undervalues my company? How about if they offer resources other than capital?
I like that question. I think it comes down to two things. If those resources really are worthwhile, often the answer is yes. So for instance, to be invested in by a top tier fund that will genuinely open doors and whose representative on your board will provide sage advice, that's worth taking a bit of a discount. The other end of that scale is there comes a point where you have very few options left. So provided you're not breaking something that you would consider you couldn't repair later, you're not letting the investor get control in this round. It could be if you're down to your last month of cash, you have to say, okay, it's a good enough fund, it gets us the money, we will change our parameters.
Okay. All right, we're moving on now to the questions that we've received through the question box. First question is, in case of small deal flow of projects to connect offer to investors, what other way, tool or activity would you suggest to build relationships with investors?
I think there's no real substitute to trying to get some kind of personal contact. And on the whole, that probably means working with your advisors and your mentors. And it could be that you are 3 degrees of separation, but generally speaking, funds in particular don't react well to simply getting something that's been submitted via a website. Whereas at least if in your introductory message, whatever form that takes, email, WhatsApp, whatever it may be, if you can say, Edouard from EBN suggested I contact you, and they know Edward, then they'll at least read the email. And the closer you've got to working with advisors or mentors who have actually had a successful deal with those investors before, the more likely they are to give you time, at least to consider your pitch and tell you what it is you would need to do to make yourself investable.
That's quite clear, David. Thanks a lot. I have a question from Xiao. What's the database that David mentioned at the beginning, I think that you often use?
Oh, right. The one I use, which mainly covers the UK, is called Bowhurst. But there are other proprietary databases, and I think it would probably be worth raising that issue as an Innovate team to see whether you can access on behalf of the members of the consortium one of the databases. So, for instance, with the UK database, when I'm looking for, let's say, companies that will invest at the 3 million level in artificial intelligence, and it's got to be in Scotland, then I can put all those parameters in and see what deals have been done recently. And it gives me a very good idea of who's active in that sector. So working with an up-to-date database really does matter.
Okay. Yeah, we've got a couple more minutes. So I'm going to take a couple more questions and then we'll conclude this webinar. A question from Christian. What is the optimal time to start searching for investment before running out of cash?
I think if you've got some well thought out proposals that show how much you'll need, why and when, and you've still got as close to 6 months cash left in the bank as possible, that's a good time to go out. Because particularly at early stages, often your investors will only fund you for about 18 months at a time. So once you've used up the first year's cash, you really need to be thinking about what you're going to do next. Now that's a counsel of perfection, but if you leave it to the last 3 months, you'll be in the position of the company whose board meeting I'm attending this afternoon, where it's a make or break meeting for them.
All right. Another question we received is, how early is too early? What is the minimum net revenue you think a startup should achieve before going for a pre-seed or seed round?
I think with a pre-seed and a seed, it's okay to be on almost ghost sales, the sort of beta sales. I think once you get to the Series A, that's where you've got to be making 6 figures of sales in most industries, and you would be able to, you'd have to be able to map a path to getting to profitability in 3 to 5 years. So at pre-seed, sales not so important, but you'd need to show how you can get them.
Okay. Another question, which I think I'll answer, is we are asking for the slides and also the webinar. So the webinar was recorded, will be made available via the Innerate website in a couple of days. So please do keep an eye out. We'll make sure to upload it then. Last question, David, if I may. What is the best way to get a suitable company valuation?
Wow. Now, interestingly, I know EBN has run some seminars on early stage company valuation. There's what's called the venture capital basis of valuation, which most investors will use one way or another. And what it depends on is starting with, you know how much money you need now, and you've been doing your projections so that you've got some idea of when you might exit, and you work out from your projections what your exit value might be based on existing comparable successful companies. You can then work back to what percentage of the company you would have to sell to the investors today, bearing in mind that they will be looking for a significant uplift in the value of their stake. So I would say that there are textbooks out there, and I can drop a line to Edward suggesting some further reading. However, it's really a question of art and negotiation rather than mathematics. You do need to master the mathematics, but they're just the starting point. The Excel spreadsheet is where you begin, not where you end. So I'll send a link to some professional reading that Edward can disseminate to the people on the call today.
That sounds good, David. So all the participants, if you would like to have access to these links, you can either drop an email to me or my colleague Eveline, and we'll make sure to forward you those links. All right, this concludes our Q&A session. Just a quick highlight here. If you appreciated this webinar, we will be having another one in the month of March, so on the 23rd of March. So this is going to be a webinar on investor strategies and options, and specifically dealing with exit strategies with one of our experts from the EBN network, so Frédéric Domas, who has set up several companies and an investor himself. So if you're interested, we will be sharing with you a registration link. And with this being said, I would like to thank David again for your very enlightening presentation. Really fun and very interesting. I'd like also to take the time to thank all the participants for joining us. If you'd like more information about the Innerate project, please do feel free to reach out to us, and I'll be more than happy to provide you with this information. Also, we're quite active on our social media channels, so if you'd like to have more information or just pay attention to the latest information, do follow us on our social media channels. We've got a lot of more fantastic investment readiness webinars and workshops coming up in the coming months, so please keep an eye out. And with this being said, I conclude the webinar and wish you all a fantastic day ahead.
Thank you.